Hi everyone, and a very good evening. A very warm welcome on behalf of Union Mutual Fund. My name is Anurag Sharma and I'm the Regional Head of Sales for Western Zone. I would hereby like to thank all the participants for taking out their time and logging in for this webinar. So we have with us our Head of Fixed Income, Mr. Parijat Agrawal, who will be decoding policy and the way forward. So yeah, without taking much of the time, I would like to hand it over to Parijat. Parijat, over to you.
Thank you, Anurag, and welcome all. So today was the much anticipated the first monetary policy for this financial year, and as expected, the MPC kept the rates on hold. Let me share the PPT which I have. Is it full screen? Okay. So let's begin. So the MPC, they kept the repo rate unchanged at 6.5. So accordingly, the standing deposit facility was at 6.25, which is 25 bips lower, and the marginal standing facility, which is 25 bips higher, and bank rate is also 25 basis higher, which was kept at 6.75. So all the policy rates remains unchanged, and however, like the last time, the view was that 5 members voted for to keep the policy rate same. 1 member voted for rates to be cut by 25 basis point. Also for the stance, the MPC also decided to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns with target while supporting growth. This stance has remained for a very long period of time. Again here, the decision for stance was also 5:1. The same member voted for it to be changed to neutral from that accommodative stance. So status quo, no changes, and this was also what market was expecting. So not much change there. However, as we go ahead, we'll see that what were the projections for growth and inflation, and why the MPC took this call to keep on status quo. Let's look at the GDP growth projections. What we have noticed is that the MPC kept the full year GDP growth, the real GDP growth numbers at 7%. It was same as last time in the last policy. For the full year, it was 7%. Only minor changes that we could see from this table is that from quarter over quarter. But overall, for every quarter, the growth is hugging that 7%. So obviously, the growth momentum has continued to be very robust and very strong. So this is one reason that could have kept the the MPC on hold also. So what were the factors that which gave these projections of closer to 7%? Let's look at them. So first was that the factors which supported domestic growth was that domestic economic activity continues to expand, and this we have seen for the last 1 full year almost at an accelerated pace, and it has been supported by fixed investment and improving global environment. So what we have seen is that the capital expenditure by Government of India, the private capex also picking up pace. So overall, there has been the spurt in the investment activity. The second advanced estimate placed real GDP growth at 7.6% for the last financial year, that is 2023-24, and this is the third consecutive year where the growth is of 7% or higher. So that's remarkable. So what we notice is that the growth momentum has continued, and it is expected to continue in this financial year also. So going ahead with the new numbers coming in, we'll be able to extrapolate that what do we see going ahead in the next few years also. Now another data point, which is that purchasers managers index, it rose to a 16-year high of 59.1 in March. It was 56.9 in February. This means that the manufacturing activity has been expanding at a very robust pace, because any number above 50 is expansionary, and 59.1 is actually extremely healthy and robust. The growth of new orders accelerated to the quickest in nearly 3.5 years. So even the growth numbers that are coming in, or the orders which are coming in, are at a very quickening pace, because demand has remained buoyant, both from the urban side as well as the consumer side. Not only manufacturing, what we notice is that even the services sector has remained extremely robust, and in fact, it has been doing much better than manufacturing. So it rose to almost 13.5-year high of 61.2 in March. It was 60.5 in February. That what it suggests is that there is a sustained expansion. It is not one-off number. What you have seen is that the numbers have remained very high, closer to between 55 to 60 for a very long period of time. So it definitely suggests that the expansion is healthy and durable. That is very crucial for us to keep in mind, that any expansion needs to be durable for it to sustain going forward. The another data point which tells us that healthy expansion is happening is on capacity utilization. So it has remained in the region of 75% for some period now, and some number closer to 75% actually tells us that economy is almost at full potential or full throttle. So it was at 74.7 in Q3 2023-24. So and long-term average is around 73.7. So very healthy numbers there. And obviously our GST collection, which is very crucial for us to for these expansions to happen. So monthly GST collections averaged 1.68 lakh crore during 2024, which was 11% higher YOY, and it is expected to continue to grow over the coming months also. So overall, all the data points are pointing towards a very healthy momentum in growth, and that's why the MPC projected for this financial year the real GDP to be closer to 7%. In our assessment, it can be revised upwards also as we go ahead. Now, obviously, there could be some risk to whatever our projections are for growth. One is obviously the global economic slowdown, and it could come from the uptick in commodity prices, which we have started seeing now, because after falling for many months low, it has again started to pick up. So we have seen that crude prices started to move up and it's closer to $90 a barrel. Volatility in global financial markets. What I mean is that we have seen that how the US dollar has been behaving. The DXY, that dollar index, it's almost touched 105. It had come down to closer to 100, and then similarly that US yields 10-year. So touched 5, went back to 3.8, again it back to 4.4, 4.31 kind of thing. So these volatilities actually tighten the financial markets. So that's one risk. The protracted geopolitical tensions, what we are noticing, the war in Ukraine and Middle East also between Israel, and the impact that we have seen is that the shipping lines have got impacted, and that obviously puts pressure on your the cost. The shipping cost goes up. Obviously, your commodity prices shoots up, and then obviously the final product prices goes up. So it has got an impact on global growth. Extreme weather conditions that we all are aware, it has happened so many times, because it definitely impacts the food prices much more than anything else. So these are the four major risk points that we need to keep in mind, even though the growth numbers look very good and the momentum continues. So after the growth, let's look at how the credit growth in the domestic market looks. It again tells me that the credit expansion is at multi-year highs, So if you look at our credit expansion, it is at 16.5% and deposit it somewhere around 13.1. So it is a multi-year high, and this clearly tells me that the increased capital expenditure is happening. So what I just said, that it is not only capex happening from the government side, but private capex is also picked up, and that is visible in my credit growth, which is there, non-food credit growth numbers, which are telling me. So, and one very heartening point here is that now it is across sectors. It is picking up across sectors. Earlier it was limited to some sectors and not broad based. But now the credit uptick is becoming more and more broad based. The retail credit continues to be very high, upwards of close to 25 to 30%. So that again is a very healthy number. And credit growth was led by higher personal loan demand in the credit side, in the personal loan growth. That's what we have seen, and increase in lending to NBFC segment. So overall, what we notice is that the capex has picked up. That's why we see in these numbers that the non-food credit is at a multi-year high. So again, it tells me that the growth momentum continues. Now, after we have looked at the growth numbers, the MPC always looks at how the inflation is looking at, because the main goal of MPC is to keep the inflation or headline inflation at closer to 4%. That is the inflation targeting that they do through their monetary policy tools. So what we notice is that the inflation has been kept at 4.5% projection for full year. It was same in the last policy also at 4.5. A slight difference that we see is from quarter over quarter. That's the only thing. But otherwise, we see that for the full year, it is projected at 4.5%. Now, what are the factors where we notice is that the inflation has started to trend downwards, or why we believe that the MPC has kept the projection at same at 4.5%, although the growth numbers look very healthy and robust. First and foremost is that the core inflation has started to moderate, and it is happening for some period now. So core inflation is basically your when you take out the food and fuel from the headline inflation. So although the headline inflation stood at 5.09 in Feb, it has started to trend downwards, and it is expected that for this month it should be closer to 4.7%. But the core inflation, the disinflation in core has happened much faster and over a longer period of time. So if you notice that, so from November onwards, what we've seen is that core inflation has continued to dip. So it was 4.3, then 4.1, then 3.9, 3.63. Then last month we saw it 3.37. So very comfortably within RBI's comfort zone of 4%. Now, when the core is down, definitely that from demand pull is, or across the broad-based manufacturing and services, the disinflation has started with the tighter monetary policy, and that definitely gives a lot of headroom for the MPC to take a call if they have to cut the rates. However, the food inflation has remained extremely volatile. So that could be one reason that the MPC decided to stay on hold despite core inflation moving to a level of 3.37. And the disinflation, as I mentioned, in core gathered momentum due to combined effects of policy rate, which we had hiked by 250 basis point, and cost push pressure across core goods and services. Everything is started to come down, but it needs to be monitored. Because commodity prices have again started to pick up. We need to see that how they move ahead in coming months. And non-core, which is basically your food inflation, has remained higher in coming months, in the past months also, because of volatile food prices. Now, that is one reason which has kept the headline inflation higher and not closer to 4%. Now, what are the reasons that the food prices have remained volatile? First is what I would call is that the climate changes, the monsoon, the heat waves, and the other factors which impact the food production or the agricultural production. So what we have seen is that generally during the summer months we see that vegetable prices goes up. We have noticed that some protein prices have moved up because of some shortages, or say for example in terms of the eggs, because there could be some bird flu or some kind of another diseases. So obviously it keeps impacting the supplies, and it has become a norm these days now because something or the other keeps happening because of the I would call it global warming or whatever you call the climate changes. So that has kept the food prices elevated or very volatile. So that is one factor which keeps the headline inflation higher than 4% rather than being lower, even though the core is at 3.37. Now, for the entire inflation, there are certain risks, as I mentioned, sustained elevation or higher prices for crude. It was somewhere around $75 to $80 a barrel. It has moved to around 90. Now, if it remains at 90 for a long period of time, definitely it's going to impact our inflation. So that's one thing to be watched. Adverse weather conditions, I just discussed. Supply side shocks, yes, it has started to come in because, as I mentioned, the geopolitical risk and the shipping lines getting impacted through the Red Sea, and the cost going up, that is impacting the supply side because you have to take a longer route. It takes a much longer period to export or import goods because that your one channel is impacted because of this war in Middle East. So that definitely there could be supply side shocks. And global commodity prices also, all the commodity prices starts to trend up, then definitely it would impact the inflation. The third point, which very very crucial for the domestic market, which impacts the interest rates, and more so in the transmission of monetary policy, is liquidity. So now what we have seen is that liquidity conditions eased during February and March because there was some spending by government of India. Normally, bunch of spending came, and we saw some easing in Feb and March. The RBI's market operations and some return leg of that USD INR sell by swap auctions also added to liquidity. Otherwise, liquidity had been in deficit mode for a very long period of time. In fact, for the last 4 to 5 months, it had remained in deficit. So obviously, when liquidity is in deficit, this banking system liquidity is in deficit, your short-term rate moves up. Your overnight rate moves from the policy rate towards the MSF rate, which is at 6.75. So obviously, your short-term rates are impacted. The T-bill rates goes up, your short-term CPCD rate goes up. So it impacts the entire short-term yield curve, and obviously it tightens the financial conditions in the market. Now, looking ahead, the RBI will remain nimble and flexible. This is what the governor just mentioned in its liquidity management through various tools. Basically, they use VRRR and VRR. VRRR is when they absorb liquidity, and VRR is when they infuse liquidity. So they will continue to use these tools to manage liquidity in the banking system. And obviously, the lot of flows which are coming in, both the equity and bonds. So RBI continues to intervene in the forex market. So obviously, your liquidity gets impacted. So our forex reserves reached an all-time high of 645.6 billion. And that's all-time high. That's a very, very comfortable number, and gives a lot of comfort in terms of stability, the external stability, or the volatility in rupee is manageable. And latest data on various external vulnerability indicators suggest improved resilience of India's external sector. So overall, the liquidity looks comfortable, or RBI would use all tools to provide liquidity to the banking system. But what we understand, or in our assessment, the RBI would continue to manage in such a way that liquidity remains closer to neutral rather than being extremely deficit or extremely surplus, because both impacts financial stability. And there were some statements on development and regulatory policies. These are on general, what we call is rupee interest derivative products, trading of sovereign green bond. So these are all self-evident. But the most crucial one was to note on the review of LCR framework. If you notice today, what's happening is that there are 24/7 banking happening through the mobile apps, or so obviously banks need more liquidity or more cash to keep with them, because payments can hit any time. So obviously the LCR requirements can go up. So obviously the large banks, they always have substantially higher LCR, but there could be challenges in case of any volatility or any risk coming into the banking system, or in terms of the liquidity. So what RBI is coming out, they want to come out with a discussion paper where they would look at this LCR framework, whether to keep it at 100% or do some changes or drinking with that, so that any risk can be minimized in terms of when there is any global impact on liquidity. So obviously in our assessment, if higher LCR is to be kept, then obviously what it means is that we expect that it is positive for the G-Secs, because obviously you will buy G-Secs for a higher LCR. So that's one point to pick it up from this statement of development regulatory policies. The rest is that trading of sovereign green bond in the International Financial Center. So these are the regular ones that UPI access for prepaid payment and other things. So regular banking and regulation policies there. This slide is also very important to understand, and how it impacts the bond market going forward. So the foreign bond inflow has spiked to 6-year high. So if you look at the this is what I have depicted from 2016 till 2024 year till date. So what we notice is that the inflows have remained very robust in the last 2 years, 2023 and 2024. So before that, it used to be negative, barring 2017. That what we noticed. So the FI inflow in G-Secs saw a remarkable jump after the inclusion in JP Morgan bond indices, and also in the Bloomberg bond indices, that has been said. So the overall what we've seen is that in excess of $12 billion has already come in. So which is and 7 billion has been added in this year, close to 70,000 rupee in last year, and so far 56,000 this year also. So again, the inflows impact the bond yields, and we could see that that demand is much higher than the supply, because the what we have noticed is that this year the fiscal is much lower at 5.1. So and gross borrowing is at 14.17 lakh crore. So demand would remain higher than the supply. So that is definitely very, very positive for the bond market. Now, fixed income markets, after looking at the various projections on growth and inflation, liquidity, and the FI flows, bond markets are looking very attractive. Now, the real policy rate continues to be very positive, because repo is at 6.5, and projected inflation is at 4.5 for financial year 25. So you have a 200 basis point real yield, which is very, very attractive and very high also. So obviously there is a lot of room for MPC to cut rates going forward. That very clearly tells me that. A. B, global central banks have put a pause on rate hikes and are about to begin the rate cut cycle. We have seen that, FMC said that there could be 3 rate cuts in this calendar year. And India's external vulnerability indicators, external debt to GDP ratio, reserve to external debt, various factors, these ratios, they are exhibiting higher resilience in comparison with the emerging market peers, as well as since the taper tantrum period of 2013. So external sector is very resilient and robust. That definitely gives a lot of comfort to not only the domestic players, but also to the FIs to invest in domestic bonds. So that's one factor why we have seen that it got included in bond indices, flows coming in. So and more buying happening in across the curve in bonds is also because of a resilient external sector. Most important factor for bond positive is your fiscal consolidation, as I mentioned. So lower fiscal deficit of 5.1 is to keep a check on supply. Obviously, when we know that fiscal slippages are not going to happen, they have not happened in the last few years. Whatever was mentioned has been adhered to, and we are on a consolidation path, and at a very fast state also. So 5.9 was revised to 5.8. Now for the next year at 5.1. So my fiscal policy is not, it is tight. So that definitely means it is bond positive. This means what supply would be less. And that's what we are noticing for this financial year. So there would be increase in GSEC demand, both the passive as well as active. Inclusion in bond indices, demand from the higher LCR, the bigger books of insurance, EPFs, pension funds, all are growing. Because as the economy grows, all these books grow. And then definitely when the supply is less, the demand is much higher. Core has started to disinflate, and it has continued for many months now. So this definitely is a very, very, what I would call it, gives a lot of comfort and room for MPC to cut rates going forward. Current account deficit continues to remain benign, and it is closer to almost, I would say, 0.5% expected for this financial year. Rupee volatility amongst the lowest in emerging market peers. Geopolitical risk, global inflation trajectory, these are some risks that we have to keep in mind because global inflation trajectory has started to come down, and what we have seen that globally it has started to trend downwards. But what we have noticed is that the last mile, basically, Fed wants to be closer to 2, but it is sticky at somewhere around 3. So, obviously, the Fed is, looking at how soon, it starts to trend towards 2% mark. Or similarly, in our context, it's around 4.5, which is projected. But to bring it down towards 4 is again that last mile, which is a little tricky. So these are the risks that we run. But anyway, the trajectory is clear because there are so many positive factors, which tells us that the rate cut narrative is definitely there. It's only a matter of time. So whether this quarter or next quarter, there could be a rate cut starting to happen. In fact, everybody is looking at FOMC to take a clue for the rate cut cycle to start. In fact, Swiss National Bank was the first one to cut the policy rate. The last week back when they cut the policy rate from 1.75 to 1.5. So it is just a matter of time when the rate cut cycle actually starts to happen. Yes, it is possible that initially the rate cut cycle could be shallow, depending upon how the data are coming out on both the growth and inflation. But trajectory is very clear. So in the near term, because we do not see rate cut happening in the very near term, maybe in a month or two, so markets are expected to remain volatile, but it would remain range bound in a very small band. It would trade. The absolute yield levels are very attractive. So you have a corporate bond which is at 7.5 with a maturity of 3 year to 10 year. Spreads are attractive from a medium to long term investment horizon. MTM gains are going to accrue as and when the rate cut starts to happen. And so if you look at the overall total holding period return, the accrual, which I just had mentioned at closer to 7 to 7.5 between this range, and when the rate cut happens, and if you're running a duration of close to say 5, or so even a 50 basis rate cut would add a substantial gain there. So overall, holding period returns would be very, very attractive. So the bond markets look very attractive in this financial year, and so one can invest, now, because you just cannot time the markets that, or you can think that you'll invest only after the rate cut starts to happen, because markets are volatile. They run much ahead of the before the policies are framed, because markets move on anticipation. So good year for the bond investors. So that was in a nutshell about what we expect going forward from the MPC, or how the various macroeconomic indicators are expected to look, and how the bond markets are looking going forward. So thank you. I'll be happy to take questions.
Thank you, Parijat, for the insights. We'll move on to the questions.
Yeah.
So there is a question: how gold price increase can have an impact on interest rates and debt markets in the near term?
See, increase in gold prices, normally, it is generally seen for the inflation. Now today, because Fed has not cut the rates, or it has postponed, so that's we have seen that the gold prices were shot up, because that's one asset class which is seen like that. Now gold prices going up may happen that investors may start looking at that, so they may not come into they try to or want to invest in the bond markets. But these are two different asset classes, and normally there is no one-to-one correlation between the bond markets and gold. So there are various factors by which the gold prices move up or come down. Now, interest rates generally are more dependent upon macroeconomic factors, like your inflation and growth numbers, which I just mentioned. So even if the prices of gold goes up, I don't see that rates are not going to come down. That could be moving up, because today the governor was saying that they are increasing their gold exposure. So some central banks are increasing their gold exposure, or there could be supply shortages there. So these are the various factors which impact gold more than the interest rate movement.
Thanks, Parijat. So the next question is by Mr. Mata Prasad Pandey from Mumbai. So he has asked a couple of questions.
Yeah.
First one is: do you see some crop damage on account of expected heat wave? Because I am
Anurag, you're not audible.
Yeah. Yeah. So the question is from Mr. Mata Prasad Pandey from Mumbai. He has asked: do you see some crop damage on account predicted by the IMD and its expected impact on the inflation?
Yes, there could be, because it is not the first time, because the unexpected temperature going up, earlier or later during this 3 months that we have noticed, April, May, June normally happens, that some zones the temperature is very high and it impacts the crop. So that's one reason why RBI has sounded caution, or MPC has sounded caution, that food prices, as I mentioned, can remain volatile because of these climatic changes. So yes, possibility is there, but would that impact the food prices drastically? My answer would be no, because we have enough buffer stocks, or we have the government is little more proactive in managing the supply, even if there is some damage or there is some low production, I would say, of agricultural produce. We have seen that during the summer, the vegetable prices shoots up because the supply is not there, because they get damaged or something.
Yeah. So then there is a follow-up question again from Mr. Madhaprasad Pandey. Historically, we have seen that the cutoff yield for the new benchmark paper is coming 2 to 3 basis points lower. So this time it was almost at the same level of 710, 711. That is the market yield. So any specific reason for the same?
Yes. See, for the last 3 years, what RBI was doing was that there was uniform pricing. That is, auction was at uniform cutoff. This means that you can bid at any price and the cutoff would be uniform. So this was implemented in 2021 after the COVID, because supply had increased and the market participants requested, because it was becoming very difficult to absorb such a at various prices. So RBI instituted that up to 30 year or less than 30 year, all the bonds which were auctioned, they were auctioned using uniform auction pricing method. So however, this financial year, all papers would be auctioned using multiple price. This means what? Wherever you bid, if you're successful, you'll get at that price. Earlier, everybody used to get at one price. So what we call in bond markets parlance is winner's curse. So if I'm too bullish, I may end up giving a higher price or lower yield. So obviously, people were trying to fine tune so that they could get the pricing right. So obviously, this kind of thing happened this time, because there's no near-term trigger for yields to go up substantially. So after a long period of time, this multiple price was started. So the market participants were a little cautious in terms of bidding. So that's why we saw that it came closer to the existing.
Okay. So the next question is, how do you see the impact of including sovereign green bond at the IFSC, that is a GIFT City, and how will it help in lowering the cost of borrowing?
See, it is just done to, I would say that, to make it more friendly to the FIIs or the players who are, would like to bid in that. So obviously, this is just one step to open up our, the trading platform. That's what I would say.
What impact do you see regarding RBI's move on ETCD, exchange traded derivatives, currency derivatives, in terms of having the mandatory such underlying?
See, I will explain this. See, the underlying, you have to keep the underlying was always there. This is what the circular, what the deputy governor explained, that to keep the underlying for the currency derivatives was always there, because it was always meant to be used for hedging. So when you're hedging, you have to have an underlying. But in order to deepen the market over a period of time, the RBI said that, okay, 5 million, 10 million, documentary evidence is not required. Then they again increased it to 100 million times. That, okay, we do not need documentary evidence of underlying, till $100 million you're doing. But over a period of time, but this policy is always there. It has to be used for hedging, and underlying has to be there. But obviously, as the market expanded, it became close to $5 billion a day kind of thing. And some players, started believing that you do not need that. This is how the narrative starts in the market. So, and because they had done over a period of time, so there were a lot of small circulars, which they combined at one place recently, the month of January. So where it was very clearly laid out everything. So then people started understanding that they have introduced. However, it was always there. So, I would say that things would change much. It remains status quo. People will fall in line, basically. Those who are believing that, it is not required. So they will fall in line and things will go back as it used to be.
Yeah. So the next question, I guess you have covered, but if you can again elaborate on this, how do you see the liquidity situation evolving over the coming months, and will RBI keep the liquidity on a tight leash?
Yes. See, the liquidity as of now has eased off because the government spending had come in, and but one thing is there the liquidity, even if it is sufficient or deficit, RBI would like to keep it extremely neutral. That very minor surplus or deficit. Deficit could be higher, but surplus definitely they are not looking at, because one can do arbitrage between money markets and forex, or the transmission of monetary policy becomes a little challenging if there is sufficient liquidity in the banking system. So obviously going at this 2 months, I do not expect sufficient liquidity because you have election months. So leakage of currency normally is very high, in the coming months during the election period. So expect liquidity to remain closer to neutral. This is what I expect in coming few months. But RBI would keep it very, very on the tighter side. That's what our expectation is.
So yeah, the next question is, so India has been trading in rupees with some, have any impact on our currency and yields?
You were not audible.
So the question is, India has been trading in rupees with some countries. Does it have any impact?
See, bilateral trading is something which everybody wants to do it because then you circumvent that the dollar trade. But somehow it is just a beginning, and it needs to be taken how it works out over a period of time. Like we wanted to do trading with Russia when the oil we were buying, but Russia said that what do I do with that Indian rupee? So some small amounts have started, and because once you start doing bilateral trading in their domestic currency, then definitely it helps. So that is one objective of this government or the RBI, to deepen the bilateral trade in rupee. But as of now, it is too small to have any impact.
So the next question is, how do you see the demand supply situation with respect to G6? I mean, will the demand or will the supply of G6 go up?
That's what I mentioned just in my the PPT earlier, that fiscal consolidation definitely is at 5.1. My gross borrowing is at 14.17. So obviously, which is closer to 1 lakh crore lesser than the last year. My GST collections are going up, so I may not need to borrow more. I may stick to the same at 5.1 this financial year. But at the same time, the FI money is coming in. The LCR is expected to have more demand because of the LCR. The books of pension fund, the EPFO, your insurance, they're all growing. So, by leaps and bounds. So the demand from them is also growing. So our expectation is that demand should be higher than actual supply.
Okay. So the next question is, can the good data points from US delay or reduce the extent of potential cuts?
Yes, because we definitely look at what's happening in the USD because of our currency. So if the inflation remains very sticky, labor market remains very strong, we could see that the FMC pushing the rate cuts further. So this is as of now what we could see. So definitely, obviously, when FMC pushes back the rate cut, even the domestic, our MPC would not cut the rates. They would look at FMC to start the rate cut cycle and then do that. And because definitely, it would impact our currency if you do that, and FMC has not done that. So yes, but one thing, please remember that the more you delay to cut the rates, the more growth impact it would have in future, because tighter policy definitely going to impact, because your borrowing is at a higher rate, your interest payment is higher, lot of things starts to build in. So obviously all central bankers are aware of this, so they will try to fine tune up time when to start the rate cut cycle.
So I don't see any more questions on the board. So I guess we can conclude the call.
Yeah.
So thank you, everyone. Thank you.
Thank you.
Thank you, Parijat, for the insights. Thank you very much.
Thank you.
Thank you.